Hello, everyone. I'm John Imhof from, I'm a partner in the law firm of Seward and Kissel. This is the alternative financing panel, and I'm very pleased we have with us some very distinguished panelists. We heard on the last session about from some bankers. These guys provide a little bit different approach to capital. We're going to try to understand a little bit better how they finance shipping and what their role in shipping is. And I'm going to just run down really quickly down the line. It's Joe Cipolla from Wafra at the very end. Ulla, I'm going to mispronounce this, but Herjut, how do you pronounce your name?
Close enough, just call me Bob.
Okay. Sean Durkin from Northern Shipping, and Peter Desloge from Maritime Finance Company, and Tobias from Icon, or formerly with Icon. Just to kick things off, I thought we would get a sense of everybody's different approach to shipping finance. And if I could, it's hard to, you all approach the markets differently. You all have a different business model. I thought it would be interesting to hear, maybe starting with you, Joe, what your approach is to shipping and how your business model works for finance.
Sure. Thanks, John. So we at Wafra are part of a diversified asset management platform, majority owned by the government of Kuwait. Our focus is really on asset-based finance and otherwise structured finance. And we've generally built that business by kind of lending to lenders in various asset-backed or structured finance business models, and are looking to grow that model in shipping. So we've generally been lending to lending platforms, as well as kind of owner-operators, which we view as somewhat similar to some of these finance platforms as well, in the sense that these are folks who know an asset class, typically have skin in the game, and hopefully can utilize that knowledge and incentive alignment to drive returns for us.
Ulla, and how about you?
Well, ship finance is pretty unique, I would say, in the market. 12-year history now, and we're the only maritime company, including Offshore, who's been consistently profitable and paid dividends every single quarter for 12 years. We have a portfolio of about 75 vessels and rigs. We have $4.4 billion charter backlog, around $4.5 billion enterprise value. We did $1 billion new investment last year, and we're definitely in business. Pretty good liquidity available for investments. We also just noted there was this trade winds, page sitting here. Investment experts exit hedge funds. Good thing is you are much smarter. You're here, hopefully taking in investment opportunities.
And Sean?
Basically, we're also an alternative capital provider to the shipping and offshore oil service industries. I think the biggest differentiator is that we're committed only to the two spaces, so we're not a generalist. We specifically focus on shipping and offshore. We have committed capital, so unlike other people that may arrange deals transaction by transaction, we raise capital in advance, and that we're able to do deals on the private side. We're very asset focused, so you'll look at people playing different parts of the market. Some people are more, credit driven. We're more tied to the asset. So if you look at our team, you'll see that we have 18 people on it, and a lot of them are naval architects and marine engineers that really allow us to get into the equipment that we finance. Our two big products are loans and leases. And when we talk about leases, they're bareboat charters. So they're like a triple net lease in real estate. So they're financial transactions. And I think where we want to play within the market is we're focused on the private companies. Probably 85% of our business is with private families. They've probably faced the biggest dislocation from either the perceived or reality of the pullback of banks from the sector. And I think we've been supporting companies that have generationally been in shipping. So I think if you get into kind of the differences between us and some of the others, it's that we're basically in the spot of the market where most of the companies are. 80% of the players are family businesses on the private side, and that's the market we serve.
Peter, your model is a little bit different from the rest of the panelists. Can you tell us a little bit about that?
Yeah, absolutely. So my name is Peter Desloge. I'm from Maritime Finance Company. We're a Bermuda-based specialty finance business, so we all live and reside in Bermuda. We are credit-focused asset investors. We are focused entirely on the maritime space, so shipping and offshore. We tend to skew a little heavier towards the offshore side than traditional shipping, but we're not a fund. We're a specialty finance company, so we have a balance sheet that we look to lend to owners and operators of vessels globally. So I'd say we are very similar in thinking, as Sean just described, but we use our balance sheet to lend for the longer term. So we're not limited in terms of scope when it comes to maritime credit. We can do anything from direct lending in terms of bilaterals to structuring and originating bonds and loans to originating in the secondary market through distressed asset purchases. So we have a pretty broad mandate in the maritime sector. We're very asset focused, and within that tend to specialize in the credit side. And like Ole, we're very much open for business.
Tobias, what are you looking to do these days?
Well, up until last week, I was the head of shipping and offshore at Icon. I'm no longer there, so I really should be on vacation somewhere, but instead I'm here talking to you. And since I'm not affiliated with anybody, I guess I can be truly honest about what I think about this market. I am in the process of setting up a new vehicle very similar to what Icon did. Unfortunately, I can't talk about that, but I can tell you what Icon did. We targeted sale-leaseback mezzanine loans similar to what the other parties at this table do. Invested about $1.4 billion to acquire 37 vessels when I was there at Icon. Target return about 15% IRR, and we exceeded that with some margin. Where we are different than the others, Icon was very credit quality focused. We're not really set up to get assets back. Didn't want to have vessels back in our lap. So that's probably where we're probably more focused on the credit counterparty than on actual assets. Of course, the question that a lot of people will ask is if you succeeded with the strategy at Icon, why are you no longer there? The simple answer is we raise money in the retail market. The retail investors today, they don't want investors in this space. This space has become an institutional capital space. The retail investors want simpler things to understand, like a loan product and a BDC. Icon started a BDC, and that's where the new retail money went in, and we wound down the fundraising for the institutional capital, for the equipment fund, as we call them. But like I say, I expect to be up and running, doing something very similar in the near term.
Where are the good sources of capital? We can talk a little bit about that. I mean, Tobias, you mentioned retail, but the sources of capital up and down the panel are very different. What do you think are the best sources for capital, and what kind of, in terms of servicing and offering flexibility to shipping customers?
Well, I think historically, both in Norway, Denmark, Germany, there was a very deep retail market for shipping investments, and that's really what Icon did as well. That is just not available today. And I think you have professional institutional investors who are going into this market, seeing the opportunity, and that's where the capital is going to come from.
Yeah. Peter, tell us a little bit about your source of capital.
Yeah, certainly. So our capital is entirely institutional. About half of our business is owned by KKR, and the other half by other institutional investors. We set up the business in a way because we wanted to provide a more permanent capital source, and that's why we set up a balance sheet. That enables us to lend and underwrite for the long term, and it enables us to offer complete flexibility and creativity when thinking about structures.
And Sean, your sources are a bit different from that.
Yeah, it's a bit different. We utilize a fund structure. We think many of the investors want to look at the period of time for which they invest in the space, and that if you do a fund, then that your investment period comes to an end, and then you run off the investments, and they wind up getting their return that way, and then they can reevaluate their next entry point if they think it's a good point in the cycle or not. Our roots are with high net worth families and basically the shipping banks. But since 2008, we raised about 75 or 80% of our capital institutionally in the U.S. They're basically all people that are like-minded. They're thinking about preservation of capital, cash flow distribution. So it's really more of a yield product than like an equity play. We're looking for the distributable yield off the underlying investments. So it's actually very similar to Ola. We've been doing this for 16 years. We've paid a distribution every quarter, and that basically keeps people coming back on the investor side.
And Ola?
Well, yeah, I would say, with a slight caveat that with us, you can actually get in and out if you like to. I mean, we're a listed company. I think we're about maybe among top 3, certainly among top 5 traded shipping stocks out there. So with a traded volume, weekly volume of around, $80 million or so you can actually get in and out of a sizable position. And that's maybe one of the distinguishing factors here, and some of the other participants here. When you commit your capital, you're stuck for a number of years. But turning that also to sourcing of capital, I mean, we use the banking market extensively. We just financed some container ships a couple of months ago with the cheapest funding we've ever had. As an analyst, I know, he ran a long-term analysis. He said, this is the cheapest capital for 5,000 years. It's remarkable. It's never been cheaper. So, and of course, we're capital agnostics, but what we like to do, we like to utilize the cheapest pieces of capital we can to generate better returns for our investors. Simple as that.
Okay. And Joe, your source of capital is kind of unique and different from the others. Can you tell us about that?
Yeah, our roots are in the Middle East, and we manage money both on behalf of our majority owner, which is the Public Institution for Social Security of Kuwait, as well as other institutional investors in the Gulf region. We manage the capital in the form of closed-end funds. And I think similar to at least some other on the panel, our investors really are focused on kind of asset backing and yield, seem to be kind of the buzzwords. And, knock on wood, there seems to be very strong appetite for growing generally, but also very specifically in transportation and maritime.
And so, having now heard a little bit about your approach to the market and what your source of capital is, I think it would be interesting to hear where you think the need is greatest for the kind of product that you offer or propose to offer. What is the ideal customer looking for these days? What is the ideal ship owner? What kind of gap do you fill that the traditional sources of capital can't? I'll throw that open to anybody who'd like to answer.
I would say, for good projects, there's always capital. Simple as that. I mean, you've been going to conferences for years and years, and you have analysts and others showing this, probably sort of big pie chart of whatever order book is not funded. Surprise, surprise, they all get delivered somehow. So I think it's all down to how are you able to pick the right projects, and what's your access to deal flow. What we like to think is that, given our association with John Fredrickson, we get to see things pretty early. Also, maybe, I did mention that earlier, but maybe one distinguishing factor is that, yes, we can do bareboats, but we much rather prefer to do time charters. Because the dilemma in the maritime space is that, bareboat, that works great, that looks pretty nice on an Excel spreadsheet. The problem is that the world doesn't really conform to Excel. So you have to be very careful with how you run the vessels. You have to be very careful on who the crew is, and because in the end, you may have a head charter that is 5 years, 10 years, maybe 15 years, but hopefully your asset is going to last longer than that. So you have to be very, very careful with how you keep your asset going. Otherwise, it's going to be a rude awakening down there when the asset that you thought would have a certain, call it residual value, isn't worth a fraction of that.
Yep. And Sean, is your approach similar, or your target customer, target ship owner?
I think, my own background is consolidation plays and roll-ups. So I came into shipping because I thought it was a good idea to do a roll-up in the dry bulk space, and that was in the late 90s. But when you broke down the market in terms of how this industry capitalizes itself, it's that every lender is in itself an asset-based lender. So what you wind up with is as you build scale, you don't differentiate your cost of capital. So, in other sectors that I've been involved in the past, what you see is the small players have little or no access to capital, so they're going to people that have very high cost of capital to get funding. And then as you get larger, you get new and incrementally cheaper forms of capital. So if you take like aircraft leasing, under half the capital comes from banks. And then there's CLOs, mezz players, securitizations, there's all these other products that basically form off of the back of where the banks don't play, and at every 50 basis point spread, then you have a new player. But it's all driven by the ratings or the investment grade ratings of the ultimate counterparties. So what happens in shipping is you don't have that. You basically have small, mid-sized companies. And so if you look at the market, you have bank debt, which is today midpoint LIBOR 300, and that's akin to a triple B rating in the institutional market. So you wonder why institutionals don't come into shipping. It's because they could do an asset-based loan in shipping, or they can institutionally invest in a triple B rated bond. So that's where one lever is. The other form of the next form of capital is somewhere around 12%. There's very little capital in the shipping space in between where banks end and where this other capital begins. So you're talking about 700 or 800 basis points where there's virtually no players. And still today, 70% of the capital comes from banks. So, if you look at like ship finance or, like the Fredericton system, they saw the void of capital. So they created their own leasing companies, and they're not the only ones that did it. And so, the alternative capital, once the banks pull back, there's very little capital to step in because none of the other forms have developed. So those of us that are sitting here today have a great opportunity because we've all invested time to understand the space. Our collective capital is irrelevant to the ultimate need to fill the void. The banks are pulling back at a greater pace than we can deploy capital. And I don't think that's going to change until the companies themselves they start to consolidate, become bigger, get rated, because otherwise they're fully dependent on borrowing on the assets. And asset-based borrowing is a very small piece of the ultimate credit market.
And Peter, your firm's focus is a little bit more on the offshore. Can you tell us a little bit about your target ship owner or target owner?
Yeah, so I think Sean raised some good points. I think we have a fairly broad mandate, so we're not there's within the credit spectrum there's no area that we will not look, beginning with the asset itself. So if the assets make sense, the structure you can backfill. So I think that and to the banking point, we don't necessarily view ourselves as competing with the banks. I think what we have the ability to offer is potentially higher leverage, creativity and structure, and then speed to closing. So from that standpoint, we can partner with the banks. We can provide an alternative to where the banks won't necessarily want to wade, but we're not viewing ourselves as directly competing with the banks themselves.
Joe, you sometimes look to partner with banks. Tell us a little bit about your model and your ideal transaction, where you fit best.
Sure. I think, you asked earlier about our target customer, and I was scribbling down some notes as you did that. And I'd say, really, our ideal target customer is, in one sense, of any size. And what we're looking for, though, is a demonstrable track record managing whatever asset they happen to specialize, whether it's an oil tanker, a dry bulk vessel, a container ship. We're kind of agnostic to that, but we want to see that owner-operator has managed the cycles well over a sustainable period of time. That's probably criteria number one. Following closely behind for us is meaningful first loss capital being injected into the transaction in which we're investing.
And Tobias, do you have anything to add to that?
I would just say, sort of interesting to note, I was at ICON for 7 years, and only one time during that period did I compete directly with any of these guys on one particular deal. And that just shows that there's so much demand for this kind of capital, that our capital is not collectively not enough to fill the gap, and that will continue to be the case.
Looking forward to something a little bit different. Where do you see the opportunities going forward? We kind of heard from the panel that bank debt is pulling back a bit from the shipping sector, creating some opportunities for the institutions represented on this panel and individuals on this panel. Where do you think opportunities are going forward? Are they everywhere? Are they particularly in the distressed sectors like dry bulk or offshore? Or where do you see your products fitting in best?
I actually think they're everywhere, and I think it's because the capital providers to shipping and offshore, they're the same regardless of the market segment. So even though the tanker market is doing very well right now, the capital available to tanker companies is provided by the same capital that goes into dry bulk and offshore. So I think opportunities will be across the sector.
We think on the offshore side that we're facing an incredible opportunity. It's going to be, in our view, a long, protracted downturn. Some of the assets that we focus on are the lower cost producing barrels, your specialized service vessels, accommodation units, things that aren't necessarily considered commodity type assets within the offshore space, but that can continue to work throughout the cycle.
Yeah, I think from our side, we tend to be more asset-driven, so we like the segments that are in the lower end of the market. So, I think in terms of like dry bulk is in play for us today. We've done a few deals in dry bulk this year. We like the product segment. We like chemicals. We like feeder container ships. And so when we think about sectors that we want to do, we want liquidity in the underlying assets. So, for instance, the offshore segment is a more difficult space for us because the assets tend to get specialized very quickly. And if you wind up with an asset back, it may be difficult to deploy. Similarly, you'll get into like VLCs or Cape where they carry one commodity and those segments are somewhat consolidated. So we really want to get into the segments that have, many market participants and at least the perceived liquidity in the assets. And so we'll probably deploy, we sit down every 3 months and go through where we think the opportunities are. So today, we're focused on feeder container ships, product carriers, chemical, and dry bulk. The crude market is tough because just from a valuation standpoint, it's at a higher point in the cycle. And offshore, generically, we're concerned on the cash flows and liquidity.
Ula?
Well, yeah, unlike some of my other fellow panelists here, our preference is to solve for optionality. What we see, and this is more a general observation, is that the market is always, overshooting on the upside, and it's call it overshooting on the downside. So if you invest, hopefully, at the right side of the cycle, and you try to grab some of the optionality, it could be a tremendous payoff. We've seen that a couple of times. We have some assets on charter to Frontline, for instance, where we renegotiated stuff. We got a profit split out of it almost for free. Ended up making a ton of money on it so far. So that's probably one of the things that it's easy to leave on the table when you're running more of a standard sort of financial setup. You may miss out on the optionality. So that's why we like operational better than financial leases. We can do both because we think optionality has significant value.
Joe, anything to add?
I'd say our outlook probably matches most closely Sean's, just to be frank. Mm-hmm. But, at the end of the day, if we kind of go back to a couple of those principles that I espoused earlier, we look for the track record, and we look for first loss capital, and we can solve a lot of problems with those two elements.
What is potentially out there that poses the biggest risk to alternative finance? Is it the cycle? Is it are banks, the threat of banks coming back as opposed to pulling back? Does that offer threats? What are the opportunities for alternative finance? I'm kind of curious to hear your view looking forward down the road, what the threats and best opportunities are. Tobias, do you want to take a crack at that?
Well, historically, our biggest competitors have been owners own equity. They'll look at a project and they go, that sounds expensive or inflexible, we'll do it ourselves. Or it's been the Norwegian bond market. Well, both of those sources of capital are not really available. The owners don't really have much capital left, and the Norwegian bond market is closed. But I think if they ever come back, that will continue to be the biggest competitive threat.
Yeah, I would echo that. I think from our standpoint, and to Sean's point earlier, I think one differentiating element that we offer versus what Ole and Sean were saying, I wanted to touch upon this, is that when we underwrite credit, we really want to create an instrument that behaves like credit, that doesn't inherently behave and have equity-like risk. And so that might be one differentiating element between our business model and theirs, in that we tend to skew more towards asset-focused, particularly on the offshore side, and on the shipping side, we'll look at some feeder container routes, some specialty chemical container routes that are part of a bigger logistics chain, but that are not necessarily the pure commodity type assets. So from a threat standpoint, a lot of our business tends to skew towards emerging markets, so it's really about execution in terms of determining who are the best counterparties within any different geography, and then what assets have the ability to withstand up cycles and down cycles.
I think from our experience, the greatest risk today is, when you have sectors that are earning below EBITDA, you're talking about in dry bulk, the burn rate is enormous because, they can't cover operating costs. So, when we look at the market, just the extent of leverage in it broadly is the greatest issue. If you look at, so shipping is comprised of primarily smaller companies that have pretty significant leverage in them, and they don't match their cash flows with fixed employment. And so when you get into periods of time like you have in dry bulk that have been, where the fundamentals have been deteriorating for 3 to 4 years, you see the first year people survive and they find their way, second year the same, third. But when you finally start getting into just negative cash flow, can't even service interest, the companies run out of money. And, so that's the greatest risk because it's hard to solve for. I mean, we ourselves have reacted since 2008. We have basically almost no leverage in our system at all. And so it puts us in a position so that if somebody can't work through it, then we can step into the asset and at least we're not facing, a bank group. But generically, I think banks are going to continue to pull back from the space. Companies are going to have to get larger. They're going to have to consolidate. They're going to have to get investment ratings. They're going to have to match revenues better with their fixed obligations on the credit side. And, so there's going to be a pretty long-term change in just the fundamentals of how shipping is going to work. And I come out of two industries that were very fragmented before. One was basically the solid waste business. It took 25 years to consolidate, and that's exactly what happened. And if you look at oil and gas in the 70s, every time there was a boom cycle, people expanded. And then when the market came off, then you had a universe of companies that didn't come through and went bankrupt. Today, they all borrow, on it. They're all investment rated. They're all borrowing in the bond market. They're not using their assets to get leverage. And when the market falls back, they can actually fall upon their assets to give them runway. Shipping, people have used their assets just to get in the business. They don't have anything to fall back on if the market is in a prolonged downturn. So, the biggest risk in shipping is duration. Down cycles are fine. It's duration of the down cycle that actually pushes people out.
And I would also say the combination of operational and financial leverage, and that's a very important to understand the difference, because that's the classic trap in the maritime world. As Sean says, they go all, they don't use financial leverage. We do because we structure the deal so that it's actually resilient to downturns. And as I said earlier, why not use the cheapest capital out there? We try to be the bank's best friends. We structure deals so the banks like them. And that is also a way we can hopefully get the superior return over time. But in general, I would say that the shipping market is a relative immature market. Just like ship finance, $4.5 billion balance sheet, still a small potato in the bigger scheme of things. So no shipping company can effectively utilize, for instance, the U.S. bond market. We're simply too small. So we haven't seen any true consolidation in the maritime world. Maybe with the exception of on the container side. Even on the crude oil tanker side, it's all very fragmented, maybe the simplest segment of all to consolidate. So we still have a long way to go to maybe become more efficient setups in this industry. In the meantime, we try to, generate super returns, pickpocketing, deals that others couldn't do while they wait to grow.
Makes sense.
Joe, any final observations?
None in particular that haven't been said.
No. Anybody else? We're out of time, so just let me ask if anyone has any final observations? None? Do we have, we may have time for one question or two? Any questions for the panelists? Well, if not, well, thank you very much, everybody. Appreciate your participation, and thank you, Capital Link.
Sure. We've had a great experience at Capital Link. This is our third time attending, second time speaking, and it's been a wonderful opportunity to meet folks in the community and share our message, which is essentially we're an alternative finance provider, open for business, and look to be here for a long time. So happy to meet folks and talk about ways in which we can do deals. Truthfully, the main thrust of our speech is that we are here to provide financing to ship owner operators and those in the community.